Hi guys, welcome back to my channel, The Wealthy Mindset. It's yours truly, Money Making Mitch. And as usual, guys, this is not financial advice. Please do your own due diligence and research. Happy Sunday. I think this is the perfect video for a Sunday. This is from the Golden Oracle of China, our very own subscriber on this channel who started his Substack on Twitter by my recommendation, actually. The guy is an economist and he's incredibly talented, and I just had to give him a little push. He does extensive, incredible research. He's also an accountant for a huge firm, and that's why I can't say who he is. Perhaps in the future we'll be able to reveal who he is, but for now, I think you guys should follow him on Twitter. I'll put the link again. It's invaluable information for real investors. And the reason why I'm telling you guys that is, remember a lot of you guys came and said on this channel that Money Making Mitch is because of you. I held my shares in the hard times and even bought the dips, some of you, because of me. Well, if you think that that gave you confidence, wait till you hear what this guy is saying. He does in-depth research as well, even dives deeper into it than I can because he's an economist. He says in his article what the bond market sees that equity investors miss in China. Because the bond market signals, it paints a picture of why you're investing into China. China's bond market is signaling stability, low yields, a steep curve, and policy flexibility, while its equity market is priced for crisis. Yes, but it's supposed to be the other way around. This disconnect creates one of the most compelling valuation gaps in global markets. In this post, we explore why the bond market quiet signals may matter more than equity markets noise, and why this could be a classic contrarian opportunity. A classic contrarian opportunity. Yes, an opportunity for us. The paradox: calm bonds, fearful stocks. So, real economy impact yields set the price of money, influencing mortgages, corporate borrowing, and fiscal health. Size and depth: the global bond market exceeds $130 trillion, larger than global equities. Investor profile: dominated by institutional players with long-term horizons. Dominated by institutional players with long-term horizon. A classic example of that is Kathy Woods bought heavily into Baidu. This just to give you an example. She bought heavily into Pony AI, just to give you an example. BlackRock bought heavily into Neo, just to give you an example. Signal power: yields reflect inflation growth and policy expectations. Policy sensitivity: central banks influence short-term rates, but long-term yields reflect confidence. In short, the bond market is where macro truths are priced in, often before they show up in GDP or earnings. Wrap your heads around that, guys. US 10-year Treasury at 4.7% inverted curve, recession risk. Let me say that again. The US 10-year Treasury at 4.7% inverted curve, a recession risk. China 10-year government bond at 1.85%, steep curve, macro stability and policy flexibility. The US yield curve in 2010 was a reliable signal of the decade of growth that followed. Remember that. Low rates, steep curve, and accommodative policy. Meanwhile, China curve today resembles the US in 2010. Wrap your heads around that. Stable, steep, and low yielding. Yes, its equity market is pricing in crisis. This disconnect is central to the undervaluation thesis. China historical yield context, and I always speak about history on this channel. China's current yield is 1.85%, is far below its 10-year 3.20% and 20-year 3.80% averages, signaling disinflation and policy room. Western economies like the US, UK, and Italy are currently above their long-term averages, reflecting inflationary pressures and tighter monetary regimes. This is a reminder of how global perceptions shift. German bonds, once considered the safest asset in the world and benchmarked as the Eurozone risk-free rate, and we all know that Germany was the powerhouse in Europe, now trade at almost 100 basis points premium to Chinese government bonds. The idea of safe is no longer static, and China's bond market, which with its calm signals may be quietly redefining what stability actually looks like. Equity market signals the Buffett indicator, my hero, Warren Buffett. The Buffett indicator, total market cap divided by GDP, is a simple yet powerful valuation tool. Warren Buffett once called it the best single measure of what valuations stand. If the bond market whispers stability, the equity market screams fair, and that's where opportunity lies. China Buffett indicator 67.4% fair to undervalued. US Buffett indicator 21.7% priced for perfection. Great disconnect. China's equity market is priced for stagnation when it shouldn't be, while the US is priced for perfection, a setup that defies macro fundamentals. Yes, it defies macro fundamentals. This also means China's equity risk premium, 6%, is significantly higher than the US 4.5%, meaning investors demand for more. Compensation for risk in China, despite its bond market signaling stability. In contrast, the US equity risk premium is compressed, leaving little margin for error. For long-term investors, this symmetry is critical. China offers more compensation for perceived risk, while the US offers less, despite mounting macro vulnerabilities. The fighter jet analogy. In global finance, the relationship between bonds and equities is fundamental, and not just for investors, but for policymakers and corporate strategists alike. At the macro level, these markets reflect shifting ideas, tides in growth, inflation, and monetary policy. At the macro level, they shape how companies fund themselves, balance risk, and pursue expansion. Understanding how these instruments interact help investors anticipate turning points, yes, while guiding firms in choosing between stability and acceleration. Imagine a cutting-edge fighter jet on a mission. The company is the jet, and its goal is to reach a high-value target growth and returns. Bond standard jet fuel, reliable propulsion, low-risk, predictable returns. Excuse me, guys, bondholders get paid first regardless of mission success. Equity afterburner, high-octane acceleration, high risk. Unlimited upside. Equity holders are last in line for safety, but first to celebrate victory. Same mission, different roles. Bond, steady equals steady propulsion. Equity, speed, and risk. What unlocks the afterburner? China's equity markets are deeply discounted, like NEO. It's deeply discounted due to property sector fallout. Disinflation, geopolitical tensions, and financial repression, all of which have driven extreme risk aversion. But with these risks largely priced in, yes, it's already priced in, and any easing could unlock outsized upside. Like, for example, if Donald J. Trump and Xi Jinping comes to a trade deal by the end of this month, making this a classic contrarian opportunity. We will explore the physiological, psychological, structural catalysts that can ignite this afterburner in future posts. Closing thoughts, the safer bet in China. Markets are noisy, headlines are reactive. Yes, people react. But the bond market with its quiet authority is telling a different story. China's yield curve is steep and stable. Inflation is subdued, policy flexibility remains intact, and yet its equity market is priced for crisis. Meanwhile, Western markets are priced for perfection. despite inverted curves, fiscal stress, and inflammatory overhangs. In a world where risk is being mispriced and narrative diverge from data, China may be the safer bet, not in spite of the fear, but because of it. Remember what Warren Buffett said, when the market is fearful, you should feed. What do you think? I'd love to hear your thoughts in the comments, guys. Do you agree that the bond market is a better guide than equity sentiment? What catalyst do you think could flip the narrative on China? Leave a comment below. I'm really excited to explore this further in future posts. There are many layers to peel and analyze, and your perspective will help shape where we go next. So I hope you guys follow him, the Golden. I'll put the link in the comment section for you guys. And I hope you guys found this video on a Sunday to be informational, inspirational, and motivational. If so, guys, don't forget to hit that thumbs up. It takes a lot of time to do these videos and the editing. And if you haven't yet subscribed, you might want to think about doing so, because in this channel, we are waking up the middle class for the first time to get a major piece of the pie from the ground level up as to how the games are played on Wall Street. And like 50 said, we get rich or we die trying, guys.